Hello ladies and gentlemen, and welcome back to another video. Today we discuss one of the topics that we always get asked the question. How do we trade mean reversion? Well, this red line here effectively shows us a key level that markets like to reach. The question is during this earnings season whether we can reach it, and then what happens next? Do we drop off? Well, we've got some great charts talking about some of the lead things that are showing us maybe the recovery is in, but at the same time, there is a chance that we actually drop off because most lows in markets tend to end with capitulation. Stay tuned as we break down the markets around the world, including stocks, commodities, and cryptos. There's so much to discuss in what is the kickoff of big earnings. See you soon. Well, welcome back everybody to the daily show where we talk about markets around the world. If you're interested in any market, that is stocks, commodities, or cryptos, always remember to subscribe and give us a thumbs up if you find value in today's video. Let's begin with some macro before we get into the charts, get into the key levels and the options. And we'll begin here with Nasdaq 100. So during most recessions, most pullbacks in markets, the Nasdaq tends to bottom first. Now, this is a mixture of growth stocks tend to find the bid first, and also that the other parts of the economy lag behind growth. So the market tends to find the low in Nasdaq first. 4 to 6 months. Have a look at Exhibit A here. 2002, we see the Nasdaq bottom at around this zone. It takes until 2003 for the SP 500 actually to find the base. The GFC 2008, we find the base early in the Nasdaq. It isn't the low for the stock market though, as we go lower into 2009, and then that is the zone or the area. You'll notice, generally speaking as well, most lows in the S&P 500 are generally what we call kind of capitulation lows. That is, the fear rises to such an extent that everyone turns bearish, and at that point, it flicks the switch. It's something that we've got to keep in the back of our mind. When everyone is bearish on something, we should potentially play the bullish side if we see it in the price action, even though it may not make sense to you at the time. If everyone is bullish, then maybe you should play the bearish side, especially in what we call technical bear markets, which we are in at this stage. A technical bear market just means over 20% down in the S&P 500. So what's happening with sentiment? Well, the general retailer is still quite negative on the markets. This has shifted already this week. People are becoming more bullish. And I think once we get the report coming out a little bit later, we surveyed our community. Only 44% of you were bearish yesterday, and the rest of you were actually bullish. Turns out it went down. Kramer must have knocked that bell all the way down to Beartown. But this is starting to shift. Notice the sentiment, 52.8% bearish, now only 46.5. If that jumps back into the 30s, maybe we need to pay attention on the charts. Investor sentiment in general is just very negative. Take a look at investor sentiment and of course where the market's economic sentiment really is at this point. Investors are well ahead with their thought process that we're in a recession. And again, dip buyers, people that are looking at the longer term approach, might be starting to say, well, maybe this isn't the worst zone if I look at a 2, 3, 4, 5 year kind of approach to the markets. Where we know the sentiment hasn't changed though is the leveraged funds. Leveraged funds, green here marked, are still trying to short this market. Investors starting to buy back in, but still at very low levels. So whatever rally we get here, at this stage seems to be short-lived, at least in terms of the big money flow. Now, why is the rally happening? Well, a lot of it is earnings expectations aren't very high. No one really wants to, go out there and say everything's going to kick ass because they don't think so. Goldman Sachs came out, hit the double bottom top. If you look at it on charts, we did the live analysis for this and basically sold off that point, but still had a very good day at one point there. IBM came in, it was an okay result. And now we come to the new tech companies. We've got Netflix. What's going to happen with Netflix and what's going to happen with Tesla? This is what most traders and investors are interested in this week. We know the banks are lackluster, maybe middling, but Tesla and Netflix, these are two X factor kind of stocks. Even Snap and Twitter, this all leads into the next week, which is the big one. That's when we see Amazon, Apple, Google, and Microsoft all come out with their earnings. We know that's going to be fireworks on this market. It may even change the direction to how we see the stock markets. For anyone that hasn't been following for a while, we do know that if we are in a recession, the average recession pullback was around 32%. This would pull the S&P 500 down to around 3,200 to 3,000. Around that level would be the average recessionary pullback. So it's not that much worse than where we currently reached recently, which was in those 3,600s. Another thing is that a lot of people are starting to put out reports saying, okay, well, let's take a look at the forward PE multiple, both with worst EPS, better EPS in terms of earnings per share, and pretty much neutral. And a lot of people are starting to say, well, maybe it's better that we start looking at 3600s, 3300s, and 3000s. They say the gorge levels at 3000. So basically that's where they would think the market is historically cheap and worthwhile maybe taking the risk on at those points. Let's get into the charts, and I want to bring together a very big understanding here that a lot of people don't have. And here is DBC, which is commodities or a commodity ETF, versus the S&P 500. Now I've got this on log, and basically what it shows us is three big levels. The level we currently reached, the level we reached back in 2011, and the GFC. Now you may think, okay, why is this important? Well, what it really was it's basically commodities versus the S&P 500. We know that inflation was here. Commodities started ramping very heavily. The cost of everything has increased. In recent weeks, that's dropped off. You can see basically the last 3 to 4 weeks, it looks like the market's telling us maybe inflation is topped, but inflation could still be here. Now, some people think that this actually correlates with the market hitting a bottom. So let's add the S&P onto this. And what you'll notice is it can also mean demand destruction is fully underway. So we saw a huge raise in the inflation in terms of what we saw in commodities, iron ore, all other commodities were getting really expensive coming into the GFC. And then it started getting crushed, basically destruction. Did it mean that the low of the market was in? In this case, it didn't. In this case, when it hit this level, it was kind of the bottoming effect of the market. So it's an interesting chart to watch. It's been one that I've been sent a few times now, and I definitely think it's worthwhile having on your charts and understanding that, of course, we need to watch commodities, but this is what we call demand destruction at this point. It doesn't necessarily mean the bottom is in for the markets. In fact, in previous cases, the markets went much lower after it, and we got this capitulation selling, which happened after that occurred. Let's have a look at some of these commodities though. We'll take a look at copper first up. Copper's kind of at a level where you would expect buyers to come back in. Demand at this stage could be kind of strong, and that's because we have previous resistances acting as support. We get that overshoot. Everyone's lost faith in this market. We'll continue to watch copper because copper is what they call Dr. Copper. It basically is the health of the economy. Think about all of the buildings that you live in, your house, you go into an industrial building, go into a mart or anything like that. All of these things required copper probably to build in those buildings. It's a huge underpinning of the US economy. So when we see the stock market go up, what do we not want to come up with it? The US 2-year. If we see rates going up and the stock market going up, it's not usually good. Here's a comparison of them both together. And you'll notice that when interest rates go up, yes, the stock market can still go up for a little while, but it has historically been quite bad. We've seen that for most of 2022 so far. At the moment, the stock market's kind of holding in its best zone it can. If it breaks out and goes long, and we see interest rates such as the US 2-year go up as well, be warned, that's a sign usually of a bull trap. And we've seen that a few times in 2022 so far. Let's move over to the US dollar. This is one good sign for anybody that's feeling bullish in the stock markets right now. Basically, we have a change of trend on the US dollar. We've made a new peak, we've busted through the last trough, and we've pulled back to this level here. Now, it doesn't mean that sellers are going to come in right now, but it's certainly a zone where sellers could come back in. If the US dollar does come back up though, hits like a 108 or something like this, this could be certainly another zone where we'd sell off, and it has changed trend on at least the 1 hour chart and every chart underneath it. That's important because if that's occurred, there could be a chance that finally we see some weakness in the US dollar. And the easiest way to really tell that the US dollar's maybe run a little bit too extreme is the 20 moving average, what we call the mean reversion moving average. You'll notice here sometimes the market gets a little bit hot and it comes back down. Sometimes it gets a little bit hot and it comes back down. Usually I like to use the weekly moving average, that is the 20 on the weekly, to really show this effect in case. And what either happens here is we get consolidation, similar to over here when it's shorted too quickly, or we get a pullback in the price, allowing the 20 moving average or the mean reversion, the indicators, everything else to reset. If you're familiar with technical analysis, that's really what you're looking at here. You're basically just saying, okay, it's moved too fast, too quickly. It's gone into probably what we call excess phase, and it's time for it to either chop or return back down. Ideally, we look for a return, that is the US dollar weakening, and the S&P 500 going up at the same time. That's what I give a green tick of approval because it's the right type of move. We'd also want the US 2-year to come down at the same time. That would be a triple trifecta. We'd like that one a lot. Let's move over to gold. Still no bid here. Nothing much to update on gold. We will continue to cover it. I know a lot of you have messaged me. I hate gold. Tom, you say, well, when you hate gold, I like gold, but I don't like it just yet. No money flow, no big traders coming in yet for gold. We will continue to update the situation as we see it. But yeah, just not finding that bid at this point. Let's check out US oil, what's going on there. So we've seen some nice pickup in oil, and we kind of had that bullish feeling on the weekend video we put out here. Obviously, subscribe to the channel if you're interested in more daily analysis on markets like this. But this showed us a bit of a bullish run. And that bullish run, as you can see here, has gone into the downward trend line. Now, I'm not going to fight with this, but this is the area where if bears are going to come back into the market, they'll try to sell it off somewhere in here. If the bulls want to get control, they take out here, which probably is a good supply. Well, it is a good supply. You take that level out, a little bit of a pullback, and then we might even begin a small rally on oil here. So be very careful in the oil market. Very critical zone. I could certainly see it shorting here. If it does go long, then most likely buyers will come in and meet each time it dips for at least the smaller time frames, maybe the next week, maybe the next couple of days. Move over to one of our favorites, Tesla. Oh, you guys love this one. I know everybody loves a good bit of Tesla, and it hit the resistance. A lot of stocks did this. Apple, which we'll take a look at in a second. Goldman Sachs hit the double bottom, the top of the double bottom, and a lot of stocks were hitting resistances as the S&P 500 was hitting the trend line in the last session. We then saw selling of this level. Now, I joke, but supposedly it's statistically likely that when Cramer rings the bell in the US, that is, he rings the bell for the stock market to open, the stocks are down. I wish I had that stat before, but he is a specter, guys. I don't know what's going on in these markets. Then we fall down here, and we're basically in what we call a triangle or a symmetrical triangle, or possibly even a pennant. And depending on how the earnings looks for Netflix into, of course, Tesla, if Tesla underperforms, we could easily go through this and potentially start a short. If Tesla overperforms, well, guess what? Maybe we have a little bit of a rally here to fill this red box gap that we've left behind. The gap is the difference between the open and the close that never filled. See how it never filled there? Very interesting zone. It did kind of get the wicks, but still I would be looking at the smaller timeframes as well. Let's check out Apple. Case in point, a lot of stocks did this in the previous session, hit the resistance highs and sold off. They came in hot. Maybe we're coming here for turnaround Tuesday. Let's have a look at some trend lines that you might be able to draw on your charts. Maybe you've got a trend line sitting like this. Maybe you've got something sitting behind. We'll just move that to a log. And basically speaking, it seems to be making a series of higher peaks and higher troughs. If we want this to be a maintained bull trend, we'd like to see Apple hold above this 144. Ideally, it doesn't make a low underneath this green candle here. And if it does, instantly would want it to buy through this current trend line. So certainly one to watch. Apple's a good barometer of the stocks. It's the biggest stock. If it's not doing well, usually the rest of the market doesn't do well. And at the moment, it seems like people are buying into the hype of the earnings, and we could be trapping. Maybe when we move to 155, the top of this previous amazing trend line, and then we start to move from that. So it's about, I think if you go non-log, you'll get this. So regular, there we go. And there's the market in terms of that trend line. So we could be trapped, maybe move up to 155. It's certainly a bet, or at least an option here in these markets. Let's move over to Dow Jones. What's going on there? Well, it's not really finding too much. Every time it hits this resistance, it seems to be struggling. It's sold off from that. Again, maybe that's the Cramer effect. Big companies here in the US, mostly the oil companies pulling down the Dow. IWM not hitting the strides of the downward trend line just yet. So IWM not currently recovering, still finding resistance. 3 lower highs here. It's time for the bulls to push through. If they can't push through in the next maybe 2 sessions, I think this thing's going down. Why? Because it's lower high, lower high, lower high. Not good. It needs to find the bid pretty fast. Nasdaq is similar, but if we look at this on the chart, if I was coming in and I was fresh and I didn't have any idea what was going on, again, kind of equal highs, still a little bit lower each time. Nice buying, which we were obviously messaging and talking about it last week. Nice buying, big wicks, shows bids are there. Everyone's so short on this market, so negative on it, that there is a real chance that we move towards that bull side. But this shows you that maybe the Nasdaq is considering bottoming. We haven't got a bottom in. It's going to need to do a lot of work. My theory here is that we're probably going to need to actually snap this downward trend line through those last 2 highs for us to say, okay, the Nasdaq probably has found base, 13,000, breaches through that. And that's a good sign that the SP500 will follow. Remember at today's start of the video, we talked about 3 to 6 months before, or 4 to 6 months before the Nasdaq bottoms off. If it did something like this, I think a lot of people will be convinced that things are looking better. What if the Nasdaq goes down? Again, this trend line is going to follow us for a while. So check it on your charts. It could be interesting. Breach of this resistance, next stop, certainly on the cards here of a potential lead up to maybe a 12.7. So some big moves could be present if the market decides it likes what it sees on the earnings. And even if it doesn't like what it sees, it still definitely could go up. Let's move over to the S&P, and I'd like to just use the mean reversion here for a second. So throughout all of 2020 into 21, we used this moving average. It's my favorite moving average, the 20 moving average. We found the weekly came back and it bounced and it bounced, and it was like the buy the dip all over the place, yeah? Then it switched and it was sell the rip all over the 20 moving average. We haven't been there for quite a few months. And while the 20 moving average is based on the last 20 weeks worth of price, it still hasn't touched it in a while. Is it due to touch it? That's the question. Where does this put us? So at the moment, the 20 moving average is at 409 on the SPY, and I'll move over to the SPX so everybody can see, depending on which market you're trading in the world, this will matter, 4,112. So basically, this is mean reversion. The market loves coming back to mean reversion, and this is where I think the bears and the bulls are going to fight it out. This would make a lot of sense on these markets if we can find a rally through earnings season, some optimism coming back into the charts, followed possibly by some pessimism. Now you'll notice we have a downward trend line here. That's because our top end of the trend line got hit. Here it is. And we sold off from that. We gapped open. That is, we opened above the previous Friday close and we sold off instantly. And you'll notice there's a little gap here that was left from previous market action the previous week. Basically, the market moved so quickly, it created a gap here, couldn't hold this, came down. We theorized there might have been a level in there. I'll talk about it in a second. It kept coming down. And at this point, we're kind of here. Now, if the stock market does go lower, fills the gap, could be some buyers coming back in. We put pressure back on the upside. We break, fill this level. That would certainly be the bull case. For bears, all they're looking at is a new low. They get a new low. You know, the bear market could really push down to like a 3,500 or even a 3,550 at that stage. Let's look at the futures here and just deep dive further into the S&P 500. Notice here the box zones. I'm not taking them away. So this is obviously the resistance we talked about in the previous session. Our thought process was probably into here, then maybe some buyers come through. Or if it does keep going down, maybe some buyers come through between 3,800 and 3,820. So far at the time of this recording, we've found buyers at 3,820. I don't know if I'm convinced that's actually the bottom. I would probably prefer it does this. And then at this point here, you would be more bullish towards the market. But let's have a look at this area here. Should you have pulled the trigger in there? Well, I don't think so. And the reason why is it didn't find any real buyers. We saw a little bit of buying coming in. It moved up, it moved down, it moved up. It made a series of lower peaks or lower highs. Where's the buyers? They weren't committed. So really it should have been a no trade. And if you sold it here and took profit here, it's still a very good thing. You could scale off your position, you could do all sorts of things, but this was certainly a very key zone. It's still worth noting that this is what the market action had done on the left-hand side, and I do still bank that. And a lot of people have messaged me, Tom, the area didn't hold. You don't know it's going to hold. Remember, it's patience. React, don't predict. And what that means is you are finding areas. You might say, well, that's prediction. Yeah, you're finding areas, but you're reacting to the price action in those. Ultimately, the best psychology is the market saying, yes, I respect the level. Look at me go. When that happens, smiley face for us, the traders, because of course we can get into those positions and then say, okay, cool. I was patient, I waited, and now things are happening. Where the options are this week seems to be around the current price. 387 is max pain for the Friday options expiration. That will change throughout the week. For anyone that hasn't been following, do not use this as a gospel. It just kind of shows where the options are expiring perfectly. And we usually use it more in the third week, which was last week. $1.9 trillion of options expired exactly on max pain. But remember, third week of the month is the best one to use. It is not a guarantee. Bitcoin came up to the level of supply. It busted through the top and is sold off since that point. So really everything's hitting resistances. Everything's hitting these top end areas and selling off. Where the explosion of buyers comes in, if you can get through these levels. That's the type of technical level where you're sitting there going, oh, that looks a lot better. Maybe we can put the squeeze on. That could be what they call the short squeeze. So will we get a short squeeze? Will we get a bull trap? The market rallies up, probably isn't over yet at this stage in terms of the short, and then we sell off. Remember, it's very good at convincing you to go a certain way and then flick the switch and it goes the opposite way. That's the whole point of these markets. It's human psychology at work. If you haven't already, come and follow us over on Twitter at FX Evolution. You can join our Discord community public. It's got 10,000 people in there sharing ideas. Shout out to the public Discord community. You guys do a great job. And of course, we do also have private streams as well. If you're interested in pre-markets and stuff, link in the description down below if you want a 7-day free trial on that. In terms of big news for the week ahead, it's really just one thing. Retail. Not the retail sales, it's the Friday over here. So we have the flash services PMI for America, and most of it's just really down to earnings. Remember, it's Tesla, Netflix. These are the ones people are watching. Let's see what happens. And of course, get buckled up because the week after this one, you'll want to subscribe. It's all about Microsoft, Google, Amazon. Woof, it's going to be big. And the big one, Apple. Can they hold the US market together? Or will it all crumble? Stay tuned, subscribe if you like the content, give us a thumbs up. See you in the next one. Bye for now.